Good afternoon, everyone. And for those of you on the West Coast, a very good morning to you. Let me be the first person to welcome you to the AIM virtual series. This is a three-part series designed to keep you and the AIM network engaged on the most pressing issues on the investment industry today. Specifically, we will explore the impact of COVID-19 on our industry, the continued importance of emerging managers, and being Asian American in the midst of the dramatic social justice movement taking place in our country today. I am Brenda Chia, board co-chair and founding board member of AIM. I would like to thank you for joining us today, especially if this is your first AIM event. Special thanks to our speakers and panelists who have taken time out of their busy schedules to share with us their insights and thoughts today. And also a very big thank you to our sponsors who have put their support behind AIM in this year of uncertainty. Our sponsors include Clear Lake Capital Group, Wells Fargo, Kirkland & Ellis, HarborVest, One Rock Capital Partners, Sideway Capital, Axia, ESO Capital, Fairview Capital, Thomas White International, Exponents, Channing Capital Management, Leading Edge Investment Advisors, Parallaxis Capital, and the Stepstone Group. We truly appreciate your continued support and engagement with the AIM network. AIM was founded in 2006 with the support of CalPERS and CalSTRS. Our founders are Mei Tom and Ginger Liu. Mei served on the board of CalPERS from 2005 to 2007 and remains a force in California politics. Ginger has had a storied career alternating between the White House, that would be the Clinton and Obama years, and the investment industry. Today, AIM is built on the energy and dedication of the full board and Jim Park, our senior advisor. The board is co-led by Sanjeev Shah of HarborVest. He has a number of colleagues in the session today, and we welcome their participation. AIM is the platform for Asian American and Pacific Islander fund managers to be more successful, whether they're starting their own firms, building careers in large firms, looking for deal partners, or hiring. With over 4,000 people in our network, there are many ways AIM supports and advocates for AAPI fund managers. I can't think of a better way to kick off our three-part series than with a keynote addressed by Tom Lee, Chief Investment Officer of the New York State Teachers Retirement System. Tom is a longtime supporter of AIM and the recipient of the 2017 Champions Award. Tom will focus on the impact of COVID-19 on investments from both a defensive and offensive perspective. We will have audience Q&A following the keynote. Then we move into a panel discussion led by AIM board member Prashant Mehrotra of Clear Lake Capital Group, a longtime industry partner of AIM. The last 10 minutes of the panel discussion will include audience Q&A. We encourage all of you to participate by submitting your questions for both the keynote and panel discussion. Please email virtual@aim.org or tweet #AIM. Let us now move right into the program. I'm looking forward to a dynamic discussion and great questions from you. We welcome our first speaker, Tom Lee.
Good morning and good afternoon, everyone. It's great to see everyone today. It almost goes without saying, but I'm going to say it anyway. We are here together in truly unprecedented times. Over the past few months, this global pandemic has impacted every aspect of our lives: personal, professional, economic, and social. And all of us have been forced to transform in ways that none of us had previously contemplated. At the same time, our country is realizing a long overdue shift in how we address the deep-rooted social issue of racial inequity. In times like these, I believe it is important to reflect on the changes we have experienced and think critically about what our role should be in the future. We have all been asked to be flexible and to pivot from what we knew to be normal, and I have been impressed by the resilience and creativity of the many individuals who are charged with ensuring business and investment continuity across our industry. But there's more than operational change taking place. We're witnessing a paradigm shift that has the potential to positively impact the investment landscape for years to come because the disruption we are experiencing is not just operational, it is cultural. And long after we return to offices, boardrooms, and airports, the true measure of change will be how clearly and how courageously we address the topic of racial equity that is front of mind today. While many recent adjustments have been fast and at times frantic and scary, I believe they have also taught us valuable lessons about what we are capable of achieving. We can and we should walk away from this experience with a new perspective, ready to take advantage of the very clear opportunity to improve and evolve the ways in which we conduct ourselves and our businesses. As we continue our discussions today, I hope we can use this forum to explore the opportunities that have arisen as a result of this unexpected environment. I know it can be easy to get overwhelmed or lose focus, particularly as we face an uncertain future. But I also know that we can affect lasting and positive change if we keep this critical dialogue going. As I've reflected on the events of the last 4 months, the actions we have taken at Neisters, and what the world might look like going forward, I see 3 overarching themes: accountability, flexibility, and empathy. In hindsight, it is not a surprise that these align with Neisters' corporate values. To explain, I'd like to take a few minutes to share my own experiences and observations. I also encourage you to think about each going forward and consider how your work and the contributions can impact the investment industry in the future. As the impact of COVID-19 was first emerging early this year, my colleagues and I were faced with the daunting task of not only thinking through how to respond from an operational perspective, but also with determining how to proactively protect Neisters' liquidity and the investment corpus that sustains our beneficiaries and their quality of life throughout retirement. We're also trying to process a rapid influx of new information from government and health officials, and we often felt like we were on a treadmill with increasing speed. All the while, our Neisters team of close to 400 colleagues was looking for a decisive directive on how their roles in our organization would move forward. We truly had to let go of the notion of business as usual. Our investment professionals immediately ceased travel. Our due diligence practices changed dramatically. Our IT staff, which was already on call 24/7, shifted to support a workforce that suddenly was almost entirely remote. Our management team didn't always have ready answers, but we were committed to making the best decisions we could with the information we had at the time. We also collectively based our decisions on Neisters' institutional values of accountability and ownership, and approached our decision-making with empathy. I believe that this approach was one of the most important aspects of our response, and that it helped secure the buy-in and inspire the flexibility that was required of our workforce. Because even in the face of massive operational change, Neisters team members kept our organization moving forward. We continue to make investments, we continue to support our members, we continue to protect our liquidity and portfolio. Team members did all of this from a distance, and their personal commitment to accountability and flexibility was invaluable to the organization. Today, I absolutely believe these themes will be key to our approach moving forward. As individuals charged with investing and overseeing large quantities of institutional capital, we have always had to operate with accountability. For Neisters, the change to remote work has meant more virtual meetings, more frequent communications with our teams and our investment managers, and more trust and flexibility for our team members as they have navigated the integration of their professional and personal responsibilities. It has also reinforced the importance of building strong relationships with our existing and prospective managers. Neisters has a long-standing practice of developing strong relationships with prospective managers before committing capital. These strong relationships are especially important to us now as we move through these uncertain times. We've never been an organization that made reactive investments or organizational decisions. This approach, deeply ingrained in our culture and processes, it has guided us through the global financial crisis and is currently guiding our practices today. Though NYSTers may be conservative in our approach to investing and asset allocation, I know without question that there is value in being dynamic and fluid in times of great change. This is true not just from the perspective of investment opportunity. There will certainly be opportunities of mispriced value, market corrections, renegotiated deals, and rebalanced portfolios. We should expect those. But right now, there's also an opportunity to take a critical look at the composition of our own organizations and those which we do business, and to make the changes we want our industry to have. NYSTers continues to participate in AIM because we know underrepresentation exists in the investment industry and that this imbalance impedes diversity, creative solutions, and new vision. For NYSTers, diversity remains an ongoing priority within our organization. The current social unrest and ongoing dialogue have heightened our awareness of and priority on these initiatives. As we continue the dialogue today, I ask that each of you think about your role in changing the face of the investment industry. Really look inward, be truthful with yourselves, and ask, what am I doing to create positive change, to create an industry of inclusion, diversity, equity, and dignity for all? Can I do more? It is incumbent upon all of us to ensure this dialogue does not fade. That means ensuring that diversity and inclusion are key topics that are not just discussed but addressed within our organizations, at conferences like this one, and with our business partners. It means having difficult and sometimes uncomfortable conversations about race, inequity, and shortcomings within our industry and organizations. It means setting tangible and achievable goals for what we expect the future to look like, inviting others to be part of creating a new normal. At NYSTers, we are focused on ensuring these initiatives stay in the spotlight. We are in the process of hiring a Chief Diversity Officer. We are thinking critically about how we recruit, interview, select, and retain talent. We remain critical of ourselves because we believe that complacency is the biggest threat to an organization's success. We also continue to strive to construct a workforce with diverse views and experiences, not just now, but as an ongoing practice. We are also committed to diversity in our managers, and that is the last point I want to make for you today. My leadership team is aligned in our commitment to working with managers from all backgrounds and at firms of all sizes. So if you review the NYSTers mission and investment program and feel that your firm is a good fit, I invite you to send us your materials. We review all submissions carefully and reply to each one that comes in. If your firm isn't a good fit, we will share your materials with our network of investors and consultants because one of them may find your strategy a good fit for their program. And even if you're not yet ready to submit materials, consider taking part in our annual MWB conference. It's a great way to connect with our team and our network of colleagues. I appreciate the opportunity to share some of my thoughts and experiences and perspectives with you today. This is a critical time for our industry, and the opportunities that exist in the face of massive uncertainty are boundless. As much as we have been tested and challenged over the last few months, I encourage you to see this as an invitation to challenge yourselves and your organizations to improve. Continue to be accountable, continue to be flexible, and continue to approach the unfamiliar with empathy and respect. We all have great responsibility and reach, and I'm looking forward to witnessing the continued momentum and change of which we all are capable. Thank you. Now I'd like to welcome back Brenda for audience questions.
Thank you very much for those insights and the information on NYSTers, which I'm sure is of great interest to our audience here. Just a reminder to our audience, you may submit questions via email on virtual@aim.org or tweet #AIM. We have our first question today, Tom. What fundraising advice do you have, especially for newer managers, through the pandemic? is now potentially the best of
Well, I
times
would
to
say
launch a
that
new fund?
much as before the pandemic, having connections with institutional investors is key. In a way, our new virtual way of dealing, I think, is an advantage for you because having these types of virtual meetings, uh, schedules may be a little more amenable. So I would reach out to folks in the institutional investor community, request Zoom meetings or meetings such as this. And but what I would really suggest is that you really understand the pension plan and their needs. I always find it incredibly important and impactful when a prospective manager comes in and explains their understanding of our plan, our investment needs, and also our investment program. So really do your homework, and that will, I think, benefit you going forward.
I think that's good advice whether or not we're in a pandemic situation. So always know before you go in and make your pitch, right?
Yes.
Great. A question from our audience. You mentioned that your due diligence process has been changed since the outbreak of COVID-19. Can you please elaborate on this?
Sure. Well, since we aren't doing in-person meetings, we've really had to rely on our network of resources that are available to us. And here are a network of resources when we are looking at plans that we may not be so familiar with. We have a number of fund-to-fund programs that we use as a resource. For example, we are partners with Leading Edge on the global investment side. We also have retained Abbott. But more importantly, our network of consultants have been a great resource for us. Callan is our general consultant, and Stepstone is our consultant for private equity, and Callan is also our consultant for real estate. So we've had to rely more on these types of resources to help us understand and provide additional perspectives on funds that we're not so necessarily familiar with.
Great. Here's another question that just came across. What's the impact of the recent economic dislocation on the global allocations you see across LPs in general, and then to the extent that you can talk about specifically for NYSTers? We're curious about that.
Sure. Well, I think we've seen much volatility in the market. In the depth of the crisis in March, NYSTers, as probably other pension funds, we were at the lower bounds in terms of our equity exposure. So just trying to maintain rebalancing ranges what was job one. Also, looking at our cash flow needs was vitally important. So just managing the portfolio on a day-to-day basis was where most of the time was being spent. But this didn't mean that we weren't also looking for opportunities. As I mentioned in my speech, there are dislocations. There may be opportunities given the current situation in terms of yield spreads in certain products. So I would encourage you that pension funds are always looking for solutions given the particular period. But the market volatility, I think, for most folks in my shoes and my staff, just to maintain rebalancing ranges was key. So that may be a challenge depending on periods of market volatility. I can probably tell you with 100% certainty that portfolio managers on public pension plans are not going to be focused on trying to arrange calls for you. So as you see tempered markets, that is your opportunity to reach out to portfolio managers, CIOs, and heads of asset classes to introduce yourselves.
What about volatility in the public markets vis-a-vis the private markets? Private equity is such a large part of any pension fund portfolio now. How do you as a CIO manage the two?
Well, it's interesting because private markets are on a 3 month, on a quarter lag, and one of the challenges is really going to be where those marks come out, particularly in real estate. The marks in private equity, those are forthcoming also. But what we've seen so far is that as part of the due diligence, every update that we have from our consultants, Stepstone, and from staff, is the impact of COVID-19. And some businesses that the GPs own are doing quite well in this period. For example, if you are a technology-based fund,
Right.
those marks are pretty good. But then if you have exposure to retail, we all see what retail has gone through, you're getting hit. So it really, you have to peel the onion, but every analysis and update includes a COVID-19 update. And how the marks come out in these private markets will be interesting because June 30th marks haven't been finalized yet.
Okay. So here's a question that came across email, and this is related to the conversation that you and I just had. How has NYSERS adjusted their capital deployment for 2020 and considerations around the broader pension portfolio in the light of volatility in the market that will be potentially driven by the denominator effect?
Mhm. Well, NYSERS is a well-funded plan. We're 99% funded. So when we look at our portfolio, we start with, our goal is to have 2 months of payroll in cash. So as part of our asset allocation meetings, 2 months of cash must be on hand. The rest is in terms of commitments. We're continuing to re-up. We're continuing to provide capital in real estate and debt strategies, etc. Because as we identify those opportunities, they remain part of our uncommitted capital. So we are aware of it in terms of where we are in terms of our rebalancing ranges and our asset allocation ranges, but we have not stopped investing because as a well-funded plan, we have the opportunity to use this period to continue to deploy capital in strategies that we think will have a long-term benefit for the plan.
I'm sure that's music to the ears of a lot of our audience today.
Mm-hmm.
Tom, we only have time for one more question, and this is related to emerging managers. How is the emerging manager landscape impacted by the racial justice movement that is so important to this country? Now, in the immediate term and in the medium term, what do you think the impact will be?
Well, I think those of us involved in AIM and the community of really moving the ball forward in terms of diversity. This is sort of the next step in terms of institutional capital, providing the resources to look at opportunities, not only from new investments, but also look at opportunities in terms of the diversity of our staff. So I would say that this is a progression. It isn't sort of a wow, we need to do this because Brenda, you're a founding member of this organization. This has been going on for years. I think the focus on this issue will necessitate that folks who aren't or have not been in a position such as NYSERS and CalPERS and CalSTRS, the Illinois funds, et cetera, who have not been on this journey, that they will now have to get on this journey. And so that provides an opportunity for all of us to sort of move the ball forward. The renewed focus, I would say, is something that is I see as a great benefit to this country because, one of the benefits of this country is that, as immigrants, we bring a great deal of perspectives, work ethic, creativity, and to harness that fully, I think is going to be a wonderful, wonderful thing to see in the years going forward.
Thank you, Tom. That's a very heartening statement. Plus, potentially more opportunity for emerging managers listening into this conversation. So we do have one last question. Can you give us more information about the new role of Chief Diversity Officer? Any long-term goals that you will be setting for NYSERS? Will it change the investment strategy or the manager selection?
I think the Chief Diversity Officer role is important because it provides a focus. much like before the global financial crisis, all of us had compliance programs, but the focus of those compliance programs were disparate. So what we want to do is ensure that there is a focal point that is empowered to ensure that NYSTers, we believe we're doing a great job, that we can do a better job. So that focal point, it'll be an office that reports to me directly as the head of the organization. And we will go down this journey of ensuring that from recruitment, retention, identification of programs to educate our staff and our partners, to have these hard conversations continues, and it is harnessed as an organization, not kind of laid out as a disparate set of conversations that happens at NYSTers.
Thank you very much, Tom. Please remember to use the AIM network when the recruiting starts for that position.
Absolutely.
We have a very robust recruiting network. Tom, thank you so much for your time today, and to our audience for joining in on the discussion. Tom, I'll see you again at the next AIM event.
Thank you.
Up next, it is my pleasure to welcome our panel presenters led by Prashant Mehrotra of Clear Lake Capital Group. Prashant, the floor is all yours.
Great. Thank you so much, Brenda. First of all, let me welcome all of our attendees to this virtual panel on exploring investment strategies in the era of COVID and social justice challenges. Before we begin, a few logistics. This is the first virtual panel for AIM and for me personally, so lots of firsts in 2020, and I want to thank all of the attendees for being a part of that. We'll get through this together, and in more ways than one, we'll get through 2020 together. So, a few other logistics: we'll be doing Q&A through the online submission of questions over email or Twitter. So please, we encourage you to do so throughout the panelist discussion, and I'll be able to address some of those questions at the end here as we're wrapping up the panel. Also, on a quick personal note, I'll warn the panelists now. You may or may not see a certain 8 or 10-year-old make a guest appearance here in the back on the panel to spy on whether their father is really actually working in his office. It's happened on many occasions in my Clear Lake Investment Committee meetings. So I'll just warn you, whatever you do, don't engage. They're full of a lot of opinions, and this panel could go in a very different direction if we go there. So, but anyway, let's get started. So we're going to attempt to cover some very important topics here on this panel. Last year, I think if we had done this panel, we would likely have been titling it, navigating choppy waters or adapting to a changing investment environment, right? And we would have highlighted the usual issues, geopolitical issues, trade tariffs, Brexit, political instability, and the various factors that could impact our portfolio and how we respectively would be adjusting our strategies. Obviously, this year and 2020 has proven itself to be very unique, perhaps defined not only by the global pandemic, but also the impact of COVID on investment decision-making, but also the social justice movements that have come so quickly to the forefront for many of us. So in many respects, both of these issues have forced investment managers to perhaps accelerate and reprioritize certain goals, including those on equity and diversity, and some of which have actually been percolating for the past few years on all of our agendas. So our panelists here very graciously offered their time. They're on the front line of these issues today, and we're going to share some views on the opportunities and challenges that institutional investors must address through their strategies in the era of COVID, as well as the social justice challenges that we currently face as a society. So let's get introduced. I'll start with myself. I'm Prashant Mehrotra. I'm a partner at Clear Lake Capital, a private equity firm that manages about $25 billion of capital under management. And we focus on a few sectors in particular, technology being one of them, as well as general industrials. And we have the great fortune of deploying capital over the last 13 years through cycles. This one is no different. And so we're seeing some pretty interesting trends and dynamics as you can imagine, and perhaps we can share some of that as we get into the discussion. I'll kick it over next to David Fan, the Vice Chairman of Axia Torrey Cove, and ask him to give a little bit of an introduction about his organization, some of the characteristics of your organization, fund size, et cetera, and your role. David?
Good morning. I'm the virtual David Fan. Some of you might see the physical David Fan eventually after COVID. Axia is a firm that focuses on hedge funds, private credit, private equity, and real assets. We advise clients globally. We have about $160 billion of assets under advisement and 250 employees with offices in London, Tokyo, Hong Kong, New York City, San Diego. And last year, I think we committed about well over $16 billion in private market commitments. Let me move on. Let my cohorts speak to themselves.
Go ahead, June.
Thanks. So I am the real June Kim, but here virtually. That was funny, David. I work for the California State Teachers Retirement System, CalSTRS. CalSTRS administers the retirement benefits for California's teachers and the school administrators and also community college professors. We have close to 1 million members, and about 70% of our members are women. Our total fund had a market value of $246 billion as of June month end. I'm responsible for the global equity asset class. It's all public equities. The market value was $110 billion. We manage the bulk of that, about $80 billion in-house in passive index strategies. And the remaining assets, about $30 billion or so, we invest with external managers in active strategies in mandates across the US, developed markets, and emerging markets. We have had a developing manager program in global equity since 2004, and it's currently managed through 3 fund of funds managers. Bivium has a US small cap strategy. Leading Edge Investment Advisors has a developed markets non-US, and Exponents, formerly known as FIS, manages the other developed market strategy for us. So thanks for having me today.
Great. We'll ask Kirk to go next.
Sure. So I work for the Teachers Retirement System of Texas. We are, depending on the market, somewhere around 150 billion. And in the I am responsible for the Emerging Manager Program. The Emerging Manager Program at Texas covers every asset class. And we look to engage with managers at an early stage and hopefully build relationships that can grow and offer the opportunity to manage capital for the broader plan. In regards to the topic at hand, I am proud to say that TRS hired a diversity and inclusion officer in 2019, at the end of 2019. And that has actually been very, very, very timely. And this is for the whole organization, not just for the investment management group. Okay, I'll hand it off.
Excellent. Go ahead, Susan.
Hi, it's so good to be with you. Thank you for having me. I'm the Director of Risk Parity, Currency Hedging, and Strategic Implementation at PESERS, Pennsylvania Public School Employees Retirement System. We are $58 billion pension plan, servicing over 500,000 school teachers, as well as school employees, active and retired members. Since GFC, we have been very intentional about the way that we manage our strategic asset allocation to really withstand and thrive in multiple market environments. I have been with PESERS for 25 years. Was named as the first female director last year after multi-decades, and second female director in 100 years. So Pennsylvania is definitely changing, and I'm responsible for overseeing the internal risk parity strategy as well as a plan-wide currency hedging program. And my recent focus has been ESG investing.
Great. Well, thank you all, and welcome to all of our panelists. So We're going to start actually with a question that I think many folks are debating real time today. And I'm going to actually ask each of the panelists, so I'll sort of direct you in no particular order. But we have to start with perhaps one of the most defining events of 2020, COVID-19. The humanitarian, social, fiscal challenges brought by COVID-19 and those still to come are historically very severe. The economic harm to businesses and investors mounts daily. For some, it's instigated massive changes, right, in how they work, prioritization of what work gets done, and frankly, what is no longer prioritized. I know we've seen significant changes in sort of just our daily operating rhythms at my own firm. So the question for the panelists will be really starting with, how has the investment environment changed for your plan in terms of process, investment themes you may be looking at now during COVID or deprioritizing? And maybe even, given a lot of this has come down to crisis management in the beginning, you could share some examples of playbooks, that may have worked or how they're holding up, and playbooks that may not have worked, right? And actions and changes that you're considering. So I'll actually start with June, maybe to kick us off here.
What started out as a very shocking financial market correction, right? If we go back to March, which was only a few months ago now, it was very much the question of liquidity. Tom mentioned it in his comments, but after we got the human side stabilized, are all our employees okay? Are we able to function and do our business operations? The focus was what's going on in the market. And we have to pay benefits every month to our members. And so liquidity was at the top of our minds. We had multiple conversations for our investment committee internally with our CIO and deputy CIO to make sure that we have the cash that was needed. If you think back to that time, markets were in stress. It wasn't just the equity market, it was the short term and the cash market as well. So it was quite a stressful few periods. But as quickly as it came about, it subsided almost as quickly, right? So if we think back, it's over. We're through it. But we still continue to have these conversations because the market, we feel, it is a bit disjointed. It's not perhaps behaving as what you'd think would be more normal given everything and all the data that's floating around. And so especially with our remote work, I think communication is key. It was important before, but it's even more important now. So it's intentional and regular communication with the investment committee members, with staff, and then a plan of action that we know that everybody on the team knows how to execute on it. And then the feedback loop of communication, when we do an investment or an allocation, so that everybody's on the same page.
Yeah. Kurt, would you like to go next?
Sure. I think that for the public side of the book, yes, there was significant concern. It was a 2-week window in March where liquidity in certain aspects, the mortgage market, repo, just went away. And for some of our managers, that had a significant impact in my book, where that was a significant amount of stress. The funny part is that, yes, it did bounce back just as quickly. And it was interesting when we immediately set up doing Q1 update calls. So, we lined up all the hedge fund managers. We dove into how are you surviving, what's going on, et cetera. And the managers that held their ground and didn't make any significant changes, April just roared back for them. So but for some of our younger managers, I will say, I think that it was a bit of a learning situation, because we have some managers who've only managed since 2008, and they were using the 2008 playbook, and the 2008 playbook did not work in this particular environment. So I think that in some cases it was a good learning opportunity. On the private and real estate side, what we were doing was we were looking at the impact, especially in real estate. We were trying to forecast what was going on as far as rentals, as far as occupancy, as far as for private equity, were any of our underlying companies, hit by being deemed non-essential, and what did that mean? Mm-hmm. So it was a lot of information flowing, but it was honestly it was more informational, because on the private capital side, you really can't do anything other than be aware that this is something that we will have to monitor going forward, and these are our flags that we have to be aware of. So that's how we dealt with things.
Yeah, no, that makes sense. The comment in particular that the 0809 playbooks, didn't always apply or didn't always work this time, I think is very, very astute. And I think some of the firms that tried that had to very quickly pivot and react.
Correct.
To your point, as we saw, with the snapback in April. David, maybe you can go next.
Sure. Well, we advise clients, so we don't actually have to worry about the execution of it per se, although I guess ultimately we're accountable. The denominator effect was a non-issue. We were hearkening back to the Great Financial Crisis playbook. We were warning our clients in March about possible denominator effect issues and unprecedented government intervention that really de-risked the equity and fixed income markets, high yield in particular, and as you know, Prashant, some aspects of the public equity market. The Fed buyback was just so unexpected, and I think markets welcomed it, certainly from a public equity side and fixed income side, and it created a very low cost, almost risk-free backstop, government backstop on securities that really supported the markets and took away some of the issues that we had thought could be problematic for our clients. So I think so far markets seem to be relatively calm given the severity of the challenges we're facing. Notwithstanding that, I think from a firm perspective, the one thing we did was we had to grapple with remote work daycare. I think you suggested it with respect to your family. We have a lot of young professionals with kids, and they were working really hard acting as professionals for Axia, but also fathers and mothers and teachers to children, school-age children. And so we did something unique. My partner Jim actually hired a puppeteer, and we had virtual daycare for the children. And
Wow.
We're getting great feedback. For 4 hours a day, we're trying to create productivity and sanity for our workforce, and it worked out pretty well. So that was probably the unexpected pivot we had to make.
That's great. That is definitely, I'm sure, not in the original charter of of the organization. So that's a great pivot. Susan, would you like to go next?
Sure. Being at Peasers in 2008 and going through this unprecedented time, I'm quite proud of our team for really having gone through this seamlessly. I just remember the panic of 2008, and I think our team went through that pretty well. I mean, we had our asset allocation was much more diversified, so it was less impacted by the equity downturn, and just being able to be at that place of peace is what really is a ground soil for making sound decisions, right? Just as June talked about, liquidity was definitely a front. We have a portfolio that it has explicit leverage to gain better diversification. So it was paramount that we manage our liquidity well, and I think we did that really well. And our asset allocation also has dedicated allocation to gold, which has been proven to be really shining during this time. So it's just, we continue to really have a very asset allocation driven investment process during this time. And having a portfolio where about a third of our assets are internally managed gives us a great ability to really move our assets around as we rebalance. And, one thing that COVID-19 had taught me is that the things that we have thought was impossible is possible. Just think about what happened to us and how the policymakers really responded with unprecedented response, right? And I think it just made us to really think about the resiliency of our portfolio in a different way, and just thinking about the wide range of outcome in the lens of inflation and growth, and what is the best way to position ourselves. And one of the golden chord that I think it's really coming through in all this is governance. Governance, focused investing, I believe is the key to having that solid, sustainable return, and kind of thinking about diversification differently. Not all the markets are, same in terms of depth and breadth. We have to really be mindful of governance in the way that we think about investing in companies as well as at the country level. So it's been a very interesting time where we just really wrestle with very, very important issues. And we came out with some new initiatives and so on. And I'm just really thankful that this unprecedented challenge was met with great teamwork.
That's great. You mentioned governance. I appreciate that, because I think it's worth discussing a little bit, right? Environmental, social, and governance factors were very much on the minds of money managers prior to 2020, mm-hmm. right? And prior to the global pandemic. Now you have this massive market dislocation, right? And it's easy to sort of take ESG and move it down on the agenda, right? And in fact, I think in the global financial crisis that happened for many firms, many investors sort of focused on solvency, to June's earlier point, right? And so what do you think is happening right now? I mean, it sounds like from your perspective, Susan, it's getting elevated in terms of managers' commitment to ESG considerations. But I'd love to get, the panelists kind of focus a little bit more. Maybe, we'll start with you, Susan, and then I'll ask June to comment.
Yeah, I think ESG is being highlighted. I think when you're constructing a portfolio that has to withstand a wide range of outcome, because it can really take off or it can really go the other way, right? So when you're thinking about those wide ranges, it's really important that you look at, do we have enough diversifying asset classes? But nominal bonds being at the yields where it is in all major countries, you say, okay, it is more important than ever before that we cannot just rely on this other asset classes to save us. It's important that every investment we make, we need to make those investments count. And we need those investments to have that high level of governance. And does it have the resiliency? Does it have that tailwind of sustainability and essentiality in their cash flows? And what is the quality of their management at the company and country level? And I think those are the important things that we need to wrestle just because of the options that we're given now. And, I think that proposal by DOJ, DOL recently about ESG having, needing to have the financial, and that is a primary focus. And I totally agree that should be our primary focus. But, when you're just focusing on financial capital management as the sole way of evaluating companies, you're missing this ESG component, which really makes the investment process much more holistic. What is the management of human capital management, natural resources management, and social capital management? And adding that really makes our investment process much more resilient. So PSERS is at its infancy in researching this. We've been researching it for a couple of years, but and of course our managers' investments, especially the fundamental equity strategies, have these golden chord in their process, but we are working to make it as more formalized a process and an initiative.
Mm-hmm. It sounds like a concerted effort to elevate it this time around, as opposed to letting it, get buried here. Yeah. June, how about CalSTRS? What are you seeing?
Well, ESG has been important to CalSTRS, the fund, and to our board for a very long time. We've had a policy in place since the 70s. So it wasn't anything new to us pre-crisis or post-crisis. But you're right, Prashant, as far as our industry, I think that pre-crisis, ESG was a very hot topic, right? As the topic du jour, indices, products being rolled out, ETFs. Never before, have I seen so many products and conversations around ESG. But what that also showed was that it was an important topic amongst investors, right? Because that's where the demand is coming from, where the conversations are coming from. That trend was already in place. One of the concerns that I had going into this crisis was that with cost cutting or with firms tightening their belts, that ESG was going to be one of the first things that gets cut, right?
Right.
Not necessarily in terms of product, but maybe the efforts and the momentum that was underway for some of the other initiatives. And, I'm really happy to say we didn't see that. That was a fear that we had, that I had, but we didn't see that. We saw managers staying committed to the ESG space. And then even more recently with the social issues that are going on and with the social justice things that are being highlighted, companies are doubling down or really increasing resources and efforts in this space. So the E, the environmental, was underway. G, governance was underway. I think there's more focus now on the S. And it's not just in terms of the investing landscape, but also in terms of staff, human capital management. Are your employees okay? The well-being of your employees, and then also throughout our community. So it's been encouraging to see. I hope that this momentum continues and that it builds, but that's been actually a nice positive to see.
That's great. No, I agree. There's a lot of momentum. The key will be can you sustain it, right? David, I guess from an advisory standpoint to funds, how are you sort of observing how funds are reacting, in terms of where they're treating or how they're looking at ESG this time around?
It's a mixed bag, truthfully. But with that said, in times of profound social change, and I think we're going through that period now of social upheaval, ESG components get reprioritized a little bit. I think with energy prices low, the environmental aspects historically have gotten de-emphasized, right? Every time energy becomes cheap, the push to renewables is not as loud as when when price of oil is high. So I think given the current energy environment, maybe the environmental aspects become de-emphasized a little bit. But I think that the social upheaval we're going through is going to be catalytic to increasing diversity among managers. I think Tom spoke about this in his comments earlier. I think there is going to be a significant push for diversity and inclusion. And it's going to be unprecedented relative to historical context. The governance piece is always the wild card in how you define it. I think people like well-governed entities where there's the breadth of perspective that gets brought into the decision-making process. Notwithstanding that, I think that the reprioritization will cause the S components to be top of mind, and hopefully it will have sustainability in the context of the investment industry.
Yeah. Well, Susan, you mentioned, and I want to get the panelists' thought on this, but there was a Department of Labor proposed regulation, right, around potentially creating actually stricter limits for ESG investing in retirement plans, and I think the question at hand was whether plan managers, bound by their fiduciary duty to their beneficiaries, are in fact sacrificing investment returns or increasing the risks to meet ESG goals. So That is definitely a hot topic. Maybe, Kirk, I'll ask you to sort
Sure.
of chime in a little bit there as to what you're seeing, if anything, around does that, give you some pause on taking ESG factors into some of the, the commitments you're making, investment decisions that you're making, and I want to hear from other panelists too. But go ahead, Kirk.
Yeah, so it's not having an impact on the business as usual as far as what we're doing here at TRS. But I understand the argument, and I think that honestly, if you focus on performance first, so what I'm finding is when I'm talking to our external managers, a number of them have ESG parts of their investment strategy. So it's embedded in the investment strategy that we're evaluating. But the evaluation is based on performance, it's based on strategy, and it's based on what we expect from the firm going forward. So I feel that if you're taking that lens, then if it's embedded in the strategy and the manager feels that it adds value to their performance, then you won't have any issues with what the Department of Labor is concerned about, that we're somehow sacrificing our duties, because we're evaluating the manager in a competitive lens versus other managers. It just happens to be that they apply this particular factor. You can almost consider it a factor. They apply this particular factor to their investment process.
Susan, you had some thoughts on this too?
Yeah, I consider ESG as an upgrade for investment industry as an overall, to really, it's a call to think more long term. It's a call for private enterprise to really identify those pain points of the society, right? The secular thematic things that's happening, and how can private enterprise come to address those pain points, and which are the companies who are doing that well in integrity and transparency and so on, with diverse perspectives. So I think that over time it's going to become an essential aspects of holistic risk management, as well as generating alpha opportunities. So I consider that proposal from them as a way to really crystallize what ESG really is. It's not. There's a lot of misperception as to what it is, and I think it just elevates us to really make it much more concrete as to what this is for. It is to generate better risk-adjusted return, making our process much more solid and sustainable over long term. And that's the common goal for everyone. Yeah.
And I want to come back to a second, Kirk, for what you were saying. Are you actually seeing an evaluation factor for your funds that your program's involved in, where ESG is specifically called out, or a form of those factors are called out?
Absolutely. So we're involved in 2 manager searches now. And as we were talking to the managers, it was surprising the number of managers who literally have in their deck, as part of their process, the ESG component. And when you dive into it, because I naturally want to dive into it and see what the value add is, they make their focus is on how they treat shareholders, how accessible is management, how impactful that company is to the environment. It was interesting that one of the managers actually had a scoring system for the managers, for the companies in their portfolio, and then could compare it to a broader score for their industry in general. So that's how detailed they look to see, for every name that was in their book, they had a ESG score for that particular company.
Interesting. Well, that's great. I mean, that shows that there's a increasing adoption
Indeed.
in the industry.
Absolutely. And I think there is, one thing that I get quite excited about ESG is you get to invest in sectors or areas of focus that it's not traditionally part of a traditional investment. So this one manager that we looked at recently invests in companies dealing with water filtration and just addressing that as one of their main core part of their natural resource strategy. So, I don't think we have a dedicated allocation to address particular sector like water. And I think that's what's kind of interesting about ESG is it doesn't just confine your investment universe, but it actually opens it up.
That's a
You
great
know,
way to say it.
let me add to that. I think ESG integration is critical, and what we're seeing in the private equity industry is the adoption of ESG scorecards or ESG due diligence, and I think it's going to be considered best practices by the industry. I think, I think that the challenge historically has been the lack of a standard scorecard or standard reporting. But I think managers have taken it upon themselves. And some of it could be driven by limited partners, and I would encourage more limited partners to push strongly to encourage general partners to consider ESG. But I think the Europeans and Asians in particular have fought hard for ESG considerations to be adopted into the thought process of evaluating companies. And if you looked at the firms that are utilizing ESG philosophy in their investment activity today, it is the very best firms that have been able to, in most cases, raise the most amount of assets. So if the thought leaders in the industry are doing it, I think it's incumbent upon the rest of the industry to follow. Otherwise, you're at a disadvantage competitively.
Yes. And I agree with what everybody has said. One last thing I'll add is that we're a long-term investor, as is Susan's fund and Kirk's fund. So CalSTRS has been around for over 100 years, and it will be around for another 100. And so the sustainability aspect, it cannot be, emphasized any more heavily, that we need returns that will be sustainable over long periods of time. And so while, yes, we grade our managers on shorter term intervals, such as 1 year, 3 year performance, but we're really seeking long-term investments and returns that are sustainable over very long periods of time to keep our fund in very good shape.
Oh, that makes sense. Very good. Well, let's pivot a little bit. We've touched on it a few times, but social justice. It's been a topic in the broader political dialogue around diversity and inclusion. It's been a critical discussion point for a while. Regardless of where you stand on the political spectrum, the pace of discussion around this topic cannot be ignored. And the recent events that have made social justice, a much more direct dialogue now, right? And so from an impact on our industry and sort of investment decision making, and in particular for allocators like yourself, do you expect there'll be a recalibration among sort of allocators around how LPs view investment firms, through this social justice lens, whether it's focusing on minority or women-owned firms, or thinking about, I think Susan, you touched on some new initiatives that are getting launched coming out of that. But let's discuss that a little bit, because there's quite a bit of change, and sometimes those periods of change can lead to some very good new things. But I am curious from the perspectives here on the panelists what you're seeing. Maybe we'll start you with June.
You're going to start with me?
Yes, if you don't mind.
Oh, start with somebody else, because
I appreciate the honesty. All right, then maybe I'll kick it to Kirk, actually.
Okay, sounds good. So look, the opportunity is unfortunate in the genesis of the opportunity. The things that we're hearing from broader organizations. This is interesting that some of the largest managers that we work with, I've been involved with some of their diversity conversations, and they have expressed their desire to make changes. When you hear some of the things that they're trying to change, you're thinking, well, why wasn't this a focus earlier? You know, so that is something that you have to kind of digest. But it is encouraging that they're thinking about making changes in senior management, making it more diverse, making changes at the board, making it more diverse. What I'm hoping to see is that if this does actually take place, that you'll get a better pipeline, that you'll get a better opportunity set for the new managers, which is who I'm focused on. I don't really care about the $18 billion managers out there. That's not my concern. My concern are the $200-300 million managers. Well, they need a fertile ground to come from. And right now, I think if we see the activity that people are saying, that fertile ground will happen. I was incredibly encouraged from hearing Tom say that they're going to hire a chief diversity officer, because I know the impact that our diversity officer has had in just the 6 months that she's been there.
Wow.
It's shocking. It is amazing how conversations open because somebody is literally only focused on that. And so at TRS, we've launched 2 what we call employee relationships groups, just from our diversity and inclusion officer being there. So as more and more firms start shining that lens and bringing that opportunity set in, nothing but good things can happen from that. That's my thoughts on this.
No,
I
that's great.
agree.
That's great.
Yeah.
Go ahead,
I
Susan.
think that's fantastic. I think that's fantastic. Pennsylvania is I'm sure we're moving towards it. You know, our membership, just like June talked about, our membership is 70% women and 30% men in terms of teachers' makeup. And as I mentioned in my intro, you know, I spend majority of my time working as the only woman in the room. And I think having that intentionality, having an awareness for one, and second step is having the intentionality, right, to bring about change, and from there is where the pipeline and, you know, all those other steps are established. So
Right.
big kudos to you, and I am initiating few things at Peasers as well. There's a high school program, Rock the Street, Wall Street.
Yes, I know them. That's an
Yeah.
awesome organization. Yes.
Yes,
Yes.
and so there are things that we can do today, and just bringing awareness to our current recruiting process, and having them be aware, because a lot of it is it's unconscious, whether it's racial or gender, it's unconscious. So when you bring it to light, when you bring light to the matter, then people are like, oh, I didn't realize that, and then
Correct.
you know there needs, you know, there is a change that's being made. So big kudos to you, because someone needs to lead that torch, and people will follow. I believe more than any other time, you know, I talked about this wide range of outcomes, and without having diverse team, especially in your senior leadership team, you're going to miss it. Just you know, the other day I was looking at my water glass, and I'm like, you know, if you have same-minded thinking group, just looking at that water glass, you're going to only see one side. You're going to totally miss the other side. You'll be totally blindsided, and you don't want it. That's not a way to run resilient company, right? So I think, and I think people want to. There's so many people, once they're awakened to this matter, they're like, oh, I want to hire more women. I want to hire more, you know, other race, but it is hard. So I think programs like this, association like this, and you know, even just me introducing this call today to my group, they're like, oh, I didn't know that there was such organization. So it's just, it starts with awareness and having intentionality, like having someone who is full-time allocated. You know, one of the, you know, the things that I talked about earlier is diversification in our asset class. And we are in this pursuit. Our entire industry pursues for diversification. That is our key to building sustainable solid return. But we're not doing it as much with our human capital. You know, can we bring that uncorrelated thought stream into our senior management team who can add that risk management, who can add identifying alpha? And I think that's going to be very, very critical, more than ever before today.
So I will jump in now, Prashant, thanks.
Go ahead.
I wasn't sure where you were going with this question. This was an area that was very important to CalSTRS before the crisis. It remains even more important now post-crisis. We have made a lot of efforts to try to better diversify the investment industry in terms of gender. We have a gender diversity workshop called Beyond Talk, where we partner with investment managers, and we're ongoing with that. As we look out across the landscape, it is broadening that to not just the diversity aspects, so not just surface level diversity, but focusing now, I think, more on the inclusion part, right? So you have a diverse staff, but will they stay? Are they able to come as their true selves to work? And it's working on ourselves internally, but also continuing to work with our investment management industry and with our partners, because I think that's the only way you will have true sustainable change. And what I firmly believe is we need to change the leadership of the industry, so to diversify the leadership, because by far, in a way, it's still very homogenous. And until we get more diversification in the leadership ranks, we won't have true change. And it takes effort on all sides, on the asset owner side, on the asset manager side, organizations such as AAIM. And I just hope that this momentum keeps going, that it's not a short-term thing, but we keep it sustained and this momentum keeps going, and that we truly do see change in the industry.
It's interesting that the historical argument for status quo was that the industry, the private equity industry, maybe the hedge fund industry as well, are apprenticeship structures. People get trained, they go through, they need years of experience to develop before they could become owners of firms or fund managers or portfolio managers. I think the change started occurring 15, 20 years ago. And a lot of it was the quants on Wall Street that generally weren't Caucasian, not to play any stereotypes. And what we're seeing today is the emergence of those that were mentored by others, and they just happen to be Asian or African American or Hispanic, and they've not dropped the ball. That is to say, there are a crop of leaders today that have ascended to the ranks of leadership and demonstrated that they could perform. So they are the pioneering folks, people like your partners, Prashant, Jose, and I think Robert Smith would be another one. Orlando Bravo would be a third. People who are now captains of industry that could demonstrate that there's no sacrifice in performance. In fact, there's enhanced performance, and partly because of whether it's because they have a different vantage point or a different approach to the business, they broke the model of what people used in the, let's say, the private equity industry, which is the business I know best. But what will cause even accelerated migration to broader diversification is the Millennial Generation, people who will march into my office and demand that we seriously accelerate our diversity and inclusion programs. And we spend more time thinking about ESG matters. And they have no fear. And they're pushing the stalwart firms to evolve, if not change more radically. And so I think there's this whole group of 25 to 35-year-olds that have figured out that they're not going to work for organizations where they don't feel passionate about going to work every day, and diversity is a part of that component. So I'm really encouraged by the current generation of young professionals including the young professionals that are members of AIM, that are forcing change, and they need to continue to speak up and push on old people like me to adopt and adapt quicker.
You know, if I could, well, what I'm encouraged by is the fact that now, when you say Vista and you say Clear Lake, those are just normal conversations now. Mm-hmm. It's no longer that they are the minority manager in this particular space.
Yes.
That makes me happy. That's what we need more of. I was having a conversation where somebody was saying, well, you know, when we say that Vista is minority owned, then somebody says, well, if I'm invested in Vista, then I fulfill my minority mandate. My response is, well, why did you even say Vista was minority owned? It's not necessary. You're judging everybody else on performance. Then if you don't put them in that book, then that mindset can't exist. So I think that you guys, what you have accomplished at Clear Lake, what Robert has accomplished at Vista, that helps the cause tremendously. It really does.
Mm-hmm. No, I think the points you're making around, sort of creating sort of good examples and examples by leadership are important. We also have to take the responsibility on ourselves, right, in terms of sustaining the momentum. I think, June and Susan, you both made the point of how do we sustain. We hope we sustain this. I can share a little bit of perspective that we're not alone. There are a lot of firms that are actively now have gone past that stage of awareness to say, what can we do? Let's do something about it, right? Mm-hmm. And it's for sure it's folks like Vista and ourselves, but now it's also other firms, right? That mm-hmm. to your point, Kirk, don't have a designation around them of minority owned or not. We're private equity firms, and we have a responsibility to demonstrate some leadership. And one of the initiatives we launched in conjunction with 10 other firms was what we're calling Modern Governance 2.0. Which is really all of us making a commitment over the next several years to have at least 2 diverse board candidates, board members in our portfolio companies, and hopefully more, right? And but that one was a really interesting exercise to go through, where it is a great idea, but as we pulled more firms into it, I think we accelerated the awareness stage because so much data came out to show just how low that diversity representation was in all of our portfolios. Right, and wow. that prompted us to actually take action, which I think we'll see where that goes over the next 3 years. But back to the point of momentum, I think it's just another example of how we can all build momentum on this.
Well, Prashant, this is going to sound perhaps radical or maybe treasonous to someone like you, but let me offer it up. I think the next chapter of diversity in private equity is young professional, mid-level professionals from organizations like Clear Lake and Vista to spin out and create their own firms. Mm-hmm. Because from my perch as a consultant, what we want to see in emerging managers is a strong background of experience where they were taught to invest in the right way with the right disciplines. And I think that universe, that cohort of well-trained professionals that could lead firms in the future are most likely coming from places like Clear Lake, Vista, Thoma Bravo, and maybe whether it's training or encouragement or development, but that would be the extension of the ecosystem. If you looked at technology companies in the valley, a lot of them came from Fairchild Semiconductor, right? They traced their roots back to one single firm. If you looked at the San Diego biotech industry, most of the great technology companies, biotech companies, came from Hypertech. Places like Clear Lake will be really the stamp of approval that will cause allocators and investors to have more confidence investing in emerging managers. And creating that training ground is critical as a part of that ecosystem.
I like the message. I think it's more positive than treasonous, for sure, David. So I appreciate that. Well, it looks like we should transition a little bit to Q&A. So first of all, let me say that we have a few questions that are being submitted, and I'll try to focus on 3 or 4 that we'll have time for the panelists here. But one that seems to come up over and over again here is sort of some of the things you mentioned, David. Right, the amount of action that was taken by the government, and the quantitative easing and the amount of support that was provided in the market to effectively allow price discovery, right? Whether it was in the secondary markets or the equity markets. And I guess the question for the panelists really is, what do you think the general consequences will be, given how there were multiple rounds, significantly massive rounds of support provided by the government? Maybe we'll chat a little bit about sort of what you think some of the consequences, positive or negative, could be. And I'll offer it to anyone who has some thoughts here on the panel.
Let me jump in there quickly, just to relay some of what I'm seeing in my book. So in my hedge fund book, I have some managers whose short book is just suffering right now, and I'm trying to dig into why are these are good managers? Why are their short books suffering? Well, you have market manipulation in the fact of this QE. So when you have this propping up of markets, then the natural actions of the markets can't really take place. So you see situations to where really good investors are saying, hey, look, I know that I've found companies that should be suffering through this. However, that's not the case. Between the inflow of capital, between the super low interest rates, et cetera. So I'm not sure how this is going to work its way through the system, but I already know that I'm having impacts on part of my book just from that.
I agree with what Kirk has said, that there's this artificial layer that has been put on investments. And as painful as it was, I think it would have been better for the market's health if we'd had like a solid shakeout and a reset. Yes. And then a back to, or more so back to fundamentals. And we didn't necessarily have that. So I worry for more medium to longer term, the effects of this, because we're basically kicking the can down the road, right? We already had all this massive stimulus from the great financial crisis, and now we have it to a greater level. How does the U.S. as a country, and these other nations, how do you work through this? It's not a sustainable, we're talking about ESG sustainability. I don't feel that this is a sustainable approach that the governments are necessarily taking, and it's very concerning, seeing how the market is trading in ways that we've never really seen it react in terms of pricing and the action that we're seeing. And that is the billion, trillion dollar question. How does this play out?
Right, and much of our financial asset returns are based on policy actions rather than, in some ways, fundamentals. But I do think that we as investors, we have to be tactical. We have to be innovative to always identify ways to add value, right? And I do agree with both of you in terms of, would I have wanted more longer period of shakeout? I do think that shakeout is actually even happening, even though you may not see it in returns. You see just huge differentiation in returns right now, whether you're looking at return, at the country level or sector level. I mean, there is a huge differentiation going on as to what are more resilient and essentiality sectors versus the one that it's actually fading out, and who are seeing the secular change that is happening, and who are sort of not as who are still playing the old playbook. Mm-hmm. And I think new normal is here. Now, you need to really broaden the way that you think about things and try to, I'm not saying throw the baby out with the bathwater, but we have to acknowledge the new normal that is here. And now how do we best generate return in a sustainable way, aligning and having that golden cord of governance as a key factor to really identify those investment opportunities. So I do agree that it seems somewhat unsustainable, but one thing I did see is, wow, politicians can come together in an effective fashion and really fill the income holes that it needed to be filled. Would they be able to do that continuously? I think policy response is going to be a huge factor in which countries and which regions are going to be successful. And would they be able to come together to make a decision that's good for the people of their nations?
Right.
So, what the repercussion of having a lot of money that is being pumped into the system, I think that's way to be seen. I think that's why having diversification is key. Yeah.
Well, I think we did, had they not done what they did, we would have probably had a depression that would have been even far more significant than the Great Depression, and it would have been far, far more devastating to all of us globally. We're still looking at, 40 million unemployed, and that's just counting people who want to work. Look, the balance sheet is going to be a problem for all of us, and the only tool to resolve the balance sheet is some form of taxation, and then I suspect that maybe we should seriously consider negative interest rates, which is going to be something obviously other countries have utilized, and borrowing $1 today with the idea that you can pay 90 cents back at some point in the future is not necessarily a bad idea when you have a massive debt obligation on your balance sheet. None of us know how this plays out. This is clearly a new fiscal model, a monetary model that we've never had to grapple with before. From an investment perspective, markets do normalize eventually. If you're a long-term investor, they've always reverted back to some sense of direction that we anticipated. It's just, this one was strange because the price discovery period was all of 2 or 3 weeks between March and April. And a lot of people took a lot of positions on the hedge fund side and got shellacked. I do think there's going to be significant pain in parts of the private equity industry, which weren't necessarily able to access parts of the government bailout, whether it's PPP or other programs that the government provided. And certainly some sectors like retail, maybe parts of the real estate industry and hospitality industry are going to be forever transformed. I don't know where those places end up, but I think the hope is we'll recover at some point, whether it's in the form of a V or a W or a U, but at some point things will get back to normal.
I agree with that last sentiment wholeheartedly. At some point, things will definitely get back to normal. It looks like we've run out of time, so I think that is hopefully a good sign of a good discussion that we were able to have a good amount of dialogue in the full hour here. So first of all, let me thank all the panelists. Really appreciate your time, your perspectives, and your willingness to share some of the lessons learned and insights you're observing today. I'll welcome back Brenda now to close out our overall virtual event. But thank you again to all of our panelists.
Thank you.
Thank you so much. Thank you so much, Prashant, and our panelists, June, Susan, Kirk, and David. I'm inspired by the impact you're having on your organizations and the investment industry, and I hope that our audience is similarly inspired. This brings our first virtual session to a close. We look forward to audience feedback to help us improve our next 2 sessions. Pivoting on what David said earlier, in late September, we will have a session dedicated to our Emerging Leaders program led by founding board member Gordon Liao. Please look out for registration and support the next generation of investors. Thank you very much for joining us, and we wish you all a very good afternoon.